Welcome to Massive Signals, where we explore the companies defining the next wave of deep tech and the inflection points that took them from lab to market. I'm David Mandel, joined by my co-founder Ari Newman. Each episode, we go deep with founders, investors, and researchers driving breakthroughs in energy, quantum, AI, defense, and the new space economy. This is Massive Signals. Cody Simms, so good to see you, and thank you so much for joining us today on Massive Signals.
Hey, thanks for having me.
Yeah, we're super excited to see you. It's we don't get to see you enough. I think I'm going to start.
You know, you guys have been the inspiration for my own hairstyle, so it's nice to get to see you both.
Look,
welcome to the club, my friend.
We've all been just hanging out and talking, right? Cool, because like the three of us have known each other for a very long time. We've got some very interesting background, but let's kind of focus on your background today, because you've had a really interesting both investor journey as well as climate journey, right? And starting as a running product for some super large companies, jumping into Techstars and the startup game, and then kind of leaving there and getting my climate journey running. And so I would love to just kind of hear a little bit about your journey from your perspective, how you got to where you are today, kind of what drove you to be so passionate about your focus on climate technology and startups. And let's kick off that way.
Well, I would say I've had sort of three major shifts in my career, and honestly, each one of them somewhat learned on the job. I'm very much a learn by doing person. Starting all the way back from when I was a youngster graduating college, I studied Chinese in college, of all things, in the late 90s. Lived in China a few times, and moved to San Francisco, trying to get a job using my Chinese language skills. But at the time, China wasn't in the WTO. We were on the heels of a big East Asian financial crisis. And I would say probably most importantly, I didn't have any other actual skills. And I fell into the dot-com boom, like totally by accident. My very first job out of college was at a startup search engine, putting websites into the search engine by hand, like literally a sort of pre-Google era web surfer that was finding websites and cataloging them. That company ended up getting acquired by NBC, spinning out, having an IPO on the NASDAQ, and about a year later was out of business, which was the boom and bust cycle of the late 90s, early 2000s dot-com boom. But at that company, I moved into a product management role and ended up building a career for over a decade in product. And that was, really late 90s, early 2000s, early mid 2000s. The field of internet product was pretty new. Today, people coming out of MBA programs want to go, be a product manager. But at the time, it was somewhat still a new field. And the idea of lean startup, the idea of agile, development, all of that was kind of coming of age in that era. And I was lucky enough to sort of be a part of that. I got to the point where in the late around 2010, 2011, was doing a lot of mentorship at startup accelerator programs about product. And, some here in LA where I live. And then a friend of mine, a former colleague of mine, was running Techstars Boulder at the time, a guy named Luke Beatty. And he invited me to come out to Boulder and spend some time with the class there. And I did, flew out a few times. And on one of my meetings, David Cohen, the CEO of Techstars, said, "Hey, you want to run Techstars in LA?" And, I said, "That's amazing. I've never even made an angel investment. I know nothing about startup investing." And he said, "You learn that part on the job. That part's not that hard. You know how to help founders. We've seen you do that. You know product, and all founders need help with product. Oh, and by the way, this first program in LA is in partnership with Disney. And we don't know much about all this media stuff, but you do. So why don't you do it?" And I did. Sure enough, I learned the investing part on the job, ended up spending almost a decade at Techstars, and, went from running that local program in LA to head of North America. I was a partner on the Techstars Ventures team, making institutional investments at seed and Series A into accelerator graduates. And I got to the point where after having worked, and so I would say that was my sort of second career pivot, right? Like moving from operating into investing. And I got to the point where I had worked with so many founders and so many companies that the companies that were really starting to motivate me were ones that I would call broadly somewhat impact oriented. So making sort of real world physical product or touching people's lives in the real world. I started leaning in on health a lot, made a few healthcare investments on the ventures side through Techstars, took a few board seats, came to pretty quickly realize that to be good at health investing, you need a huge Rolodex of health systems, which I didn't have. And then started really leaning in on the energy and climate side. Techstars had some amazing accelerator programs in that area that really served as a great learning ground for me. And by the way, this was all right around the time of COVID. So, there was just I think all of us were kind of trying to find our purpose. And I ended up, spending time. Techstars had an energy program with Equinor in Oslo. They had a mobility program with Ford in Detroit. They had nature-based carbon removal and water accelerator with the Nature Conservancy in Denver. They had a food and ag program with Cargill in the Twin Cities of Minneapolis. And these weren't all necessarily climate themed, but they had a lot of companies working on these problems. I started leaning in hard on that, ended up creating a role for myself at Techstars as head of climate and sustainability. And then as part of that, I discovered this podcast called My Climate Journey that this entrepreneur I also knew through Techstars, Jason Jacobs, had started. And that led me to my third chapter, which is, sort of moving into being an investor in the climate and energy space. And we can unpack from there, I guess, how that happened if you want.
Now, just for the audience, Cody and I worked together at Techstars for years, so we had a lot of shared history there. And Cody, I remember a story, correct me if I'm wrong, that your interest in climate and sustainability predates a lot of what you just talked about, because didn't you have a vintage Mercedes that you modified to run on fry oil back ages ago?
I did. Yeah, I probably bought that in about 2007. I had a Mercedes 300D. I modified it to run on vegetable oil, waste vegetable oil. It smelled like popcorn driving down the street. I don't know how actually good that is from an emissions perspective. I'm sure it was releasing all sorts of crap into the atmosphere. But that was a motivation for me. It was like, how do I do something that doesn't, sort of require oil to run the car? We also had a Prius pretty early on in the cycle. And, I was in LA. I don't live near the ocean anymore, but I used to surf a lot, and just sort of being aware of natural environments around me has always been really important to me.
And so your evolution and sort of you just kept leaning in because it was resonating with you at a personal level, right?
Yeah, that's right. I mean, a former colleague of both of ours, Don Loeb, one time many years ago, before we were colleagues at Techstars, I was talking with him about some career advice, and he gave me a quote that I still remember to this day. He said, "Look, you can try to pursue what you think is a good career path, and you'll wake up in 25 or 30 years and you'll have had a career. Or you can try to pursue what seems interesting to you, and you can wake up in 25 or 30 years and have had an interesting life." And I've always really subscribed to that. I am a total generalist. As I said, I studied Chinese in college of all things. And I have always been sort of a learn by doing person, and leaning into the things that drive my interest and getting good at them, but not being afraid to tackle something else I don't know.
So, all right, Cody, here at Massive, and specifically Massive Signals, we focus on key inflection points, right? So what are those critical points of change that change trajectory of either a human or a company over time, and how do we assess them? And you've had a couple of significant ones, right? And so this is kind of a multi-stage question. So I would like to hear about how the conversation at Techstars went when you decided you wanted to be the head of climate sustainability, and what was the key driver for that? And then I would also love to hear, when you what forced you to decide to go all in on investing in climate, and what were the key kind of inflection points there for you?
Yeah, let me try to unpack that, in a few directions. I mean, I think at Techstars, I'd been fortunate enough to have been there for a while. We were at this inflection point as a business because, like I said, it was right around the time of COVID. And I had actually spent some time exploring Techstars' expansion into China in 2019, going back to my past history.
I remember that.
My goodness, thank everything we didn't up and move to China in 2019. Can you imagine?
No.
My wife had given notice at her job that we were going to go do that. And we ultimately decided, and Techstars decided it was not the right time. And I was sort of, again, I had gotten to the point where I was trying to figure out what are the things that I want to lean in on. I got motivated by, like I said, I'd been doing some healthcare investing, but got motivated by some of these programs that Techstars was running. And, it was this time of COVID. We were all trying to find purpose, I think. We were all trying to figure out how can we work on something that's bigger than ourselves? How can we do something that makes a big difference in the world? I went all in pretty quick. I mean, I spent some time at some of these accelerator programs, was really excited by some of what I was seeing in terms of companies focused on new energy technologies, companies focused on pushing solar aggressively across the energy value chain, which, we were in the midst of this J curve on. We still are, frankly, regardless of what's happening in Washington. And we were in the midst of new innovations starting to happen around things like carbon removal. We had a few interesting companies in the Techstars program that were doing work there. And I decided this is the thing I wanted to do. And then, like I said, how I really went all in is I discovered, in addition to the things going on inside Techstars, I discovered this podcast, which was called My Climate Journey. It was founded by an entrepreneur, a guy named Jason Jacobs. He also was learning climate, learning energy on the go, on the fly. And that's what that pod was all about. So he had previously built an app called Runkeeper, which was a running and fitness app that he sold.
I remember that.
Yeah.
Yep. Yeah, we both remember that.
So Jason had started this pod. He was getting interviews with sort of a who's who of people in the climate space, some of which were startups, some of which were Techstars startups that I knew. And it just felt like he and I were on a very similar journey at the time. He ended up raising a small fund through AngelList in late 2020. I became a small LP in that fund. We just kept talking. And next thing you knew, by mid 2021, we had agreed he was ready to scale up the platform, and we agreed for me to join him. And so that's when I moved over and joined MCJ full time. Today, we're a early stage venture fund. We have a little over $115 million under management. I'm managing partner of the fund. I have 3 other partners. I host the pod, which we renamed about a year and a half ago to Inevitable, and it's been a fantastic journey.
Cody, I'm so curious, what was the inflection point or the moment for you guys at MCJ when you knew it was time to go from AngelList? I think you were running rolling funds, if I'm not mistaken. What were the signals that you were getting that sort of said, hey, like we can go raise a larger fund and there's enough market opportunity, and related to that, not just enough market opportunity, but enough conviction that we can return a substantial fund in this category? What was going on, and like what indicators did you have?
Yeah, you're right. So we raised about our first $35 million through AngelList, through these rolling fund platforms. And that was from late 2020, which again, Jason really started the first, couple of quarters of those funds wholly by himself. And then, he brought me in, and we sort of built the team, as a group together. Other partners that we brought in were David Aronoff, who was a 25-year VC veteran at Flybridge in Boston, and before that as a GP at Greylock. We brought in Yin Liu, who had been prior to joining MCJ, had been with Sheryl Sandberg's family office, and Tai Nguyen, who had been really with Jason since the very start, first as his chief of staff, but had been making a bunch of great early stage investments too. So that became the partnership. We got to the point where I would say AngelList was a great platform early on. Our early LP base at MCJ was almost all individuals, amazing individuals, leaders in their field, exited founders, GPs at major venture firms, clean tech veterans, and, kind of snowballed this thing, which again, Jason really, really was the early catalyst driving all of that. I was an LP. He sucked me in, right? And we got to the point where the interest was coming to us from places that maybe needed a bit more reporting than the AngelList platform was delivering for us, at least. And I would say more importantly, we had a team of 9 or 10 people. And with a quarterly rolling fund, your budget really is only known to the next quarter. And so we got to the point where we needed a little bit more line of sight into, stability on our operating budget and what that would look like. And so we decided in mid-2022 to go raise a traditionally structured fund. We held final close on all of our rolling funds in Q4 of 2022 and told our LPs at that time that if they wanted to continue to invest with MCJ, we'd love to have them. We would move them into this more traditionally structured fund. We held a first close on that fund in Q1 of 2023. And that became what is our current, what we call our second fund vintage, MCJ 2023, which is a little bit over an $80 million fund vehicle.
Great.
So you obviously early on you got really lucky with some very passionate partners and co-founders in investing in climate. And Ari and I were very interested in climate ourselves. As you're well aware, we've been lucky enough to be able to do a couple of investments together, right? But recently, climate's gotten a little bit of a bad name. And it's kind of taken a hit in the financial markets, right? From the LP perspective and the focus perspective. And too many people are associating it with impact investing versus just traditional venture investing. Has that caused you guys to refocus your strategy at all? Are you still all in? Has it affected fundraising? Like, what's your take on the overall atmosphere to stick with a theme on climate tech investing?
Yeah. I would say, a few things have happened in the last few years. I mean, one, I think there was a wave of public company SPACs in 2021, 2022 that really rode sort of the ESG wave. And, in some cases, in many cases, some have underperformed in public markets. They probably went out a little bit too early. We were in the ZERP period where there was just, I would say, frothiness in the market all around. I would say from a startup perspective, however, it's still a very vibrant time. I would say some of the drivers of what is driving the vibrancy have shifted in the last couple years. And I can try to unpack that. I would say in when MCJ was really getting going, 2020, 2021, there was a ton of momentum in, I would call it broad climate tech. And, that included everything from energy to nature-based solutions, forestry, carbon sinks, carbon removal. There was a huge wave of net zero commitments from Fortune 500 companies. There were all, the slate of billion-dollar funds getting raised. Again, I think, there was also the ZERP phenomenon going on, zero interest rate phenomenon going on, as I mentioned. And then, where we are today, there's obviously been an administration shift in Washington, which has certainly changed the tenor and story of what corporations are talking about today for whatever reason. First of all, though, I mean, climate change is not going away, right? Like it is, climate change doesn't care who's in office in Washington.
That's right.
Yeah. The problems that we face as humans, whether it's wildfires, floods. I mean, I live in LA. Obviously, we just had a catastrophic wildfire here. You all live in Colorado. The Denver Boulder area had one a couple years ago. Flooding, hurricanes. Look what happened in North Carolina recently. These things are real, right? They're not. They don't care what's happening in Washington. They don't care what's happening in the financial markets. Unfortunately, U.S. losses from billion-dollar climate disasters are up 8x from the 1980s. So that's a very real phenomenon that unfortunately isn't getting better. Utilities are increasing their resilience spend by 15 to 20 to 25% annually right now, because supporting the ongoing functioning of our power grid is paramount and is the backbone of what makes America work. And then you have this sort of additional sort of driver that is new in the last 2 or 3 years, which is the whole data center AI wave,
energy consumption explosion, for lack of a better term.
It's really 3 things, right? It's this data center AI wave. It's the electrification of everything, whether it's, no matter what Washington wants, like EVs are a trend that's out of the bottle,
right?
But beyond that, like electrification is getting driven throughout industry. One of the fastest electrifying industries right now is oil refining. That they are using, electric power to do a lot of things that a few years ago they were using fossil fuels to power. And then the third being, just all the emphasis on onshoring of manufacturing is driving more energy consumption. So all of those are huge tailwinds in this space, whether you call it climate or whether you call it energy or whether you call it resilience.
That's what I was going to ask about is, it's branding at this point, right?
Yeah. Well, it's interesting because everything gets politicized, and not that we want to go deep on touching the third rail of the administration.
We live in that space in this world. So I'm happy to go as deep as you want.
All right. So let's go a little deeper on this, right? I think this is a really important point for investors and operators and founders in these domains. In the previous administration, climate and climate change and sustainability, the zeitgeist and the focus was carbon offset, greenhouse gases, earth warming. The scientists say the oceans are going to get too hot and everything's going to fall off the deep end. And climate's the whole Democrat and Republican climate science debate gets caught up in whether 1 + 1 = 2 when it comes to ocean temperatures rising. And not that we're here to debate whether that's true. We all know that these things are happening. But I think the shift is, instead of talking about climate solutions as pure offsets or carbon scrubbing or direct air capture as the hot thing that everyone wants to fund, the shift now is sustainable and durable energy solutions. And we have, at the end of the day, if we create sustainable and durable energy solutions, we get to the same endpoint, right? Which is, if we're able to produce energy without burning fossil fuel, we're decreasing, at least from that perspective, the amount of greenhouse gas that we're contributing. We got lots of other things to fix, like the airline industry and all the other, burning carbon domains. But I actually think that the conversation has evolved positively now, because we're talking about solving an existential problem for national security of the United States and America, as you said, which is, if we can't produce enough energy, we're going to have much bigger problems than just ocean warming alone.
Yeah, we've done some policy things that are dumb, right? Like, cutting off solar tax credits and wind tax credits, or just slowing down deployment of what's becoming the most economical form of energy and power generation domestically today. But I think I generally agree with what you said, Ari. I think there is a time value to carbon and emissions. So, it's yes, we for the betterment of society, we want to increase, I think AI can help us solve a lot of these problems. I think quantum computing can help us solve a lot of these problems. But you also can't just say, sure, so let's just burn everything we can, and then 20 years from now, we'll have all the compute power we need to solve all the problems. That doesn't work either, because again, there's a time value to carbon emissions going up in the atmosphere. But I think generally, what you're seeing right now is industry in the US trying to come at it from a pragmatic approach of, you can't be perfect. You can't just say we're not going to do anything that isn't zero emissions, because it actually does slow down progress that can make things better.
Yep. I think that's well said. And shifting gears a little bit, I'd love to talk about where MCJ is investing.
Yeah.
We've got, a shared portfolio company. I'm sure there'll be more in the future.
We've got 2 shared portfolio companies.
Oh, that's right. We're happy to talk about those. But, I want to just dive into something related to this entire energy production topic.
Yeah.
Which is, MCJ invests in both fusion and fission, as well as other energy solutions.
Yep.
So zooming out a little bit, what's your take on the sort of atomic sector of energy production? I've got a cascading series of questions for you to unpack. So how do you think about investing in both fusion and fission? Because they're both super capital intensive and they're always, a couple years away.
Sure.
Who's gonna get to meaningful base load contribution on the grid first? And then how do you think about, from a portfolio standpoint, where you want to place these bets to see an entire ecosystem rise together to really solve the problem?
Sure. Just to not, leave people hanging on David's comments, we have two common portfolio companies. We have Exawatt, which is providing, clean dispatchable baseload power and storage for data centers. And we also have Arctic, which is an electric cold chain device for transporting pharmaceuticals and other goods that need to stay heavily temperature controlled with end-to-end logistics tracking on them. So we can go into both of those at any point, but let's talk about fission and fusion to start. I mean, first of all, fission is around 20% of US baseload power today, right? So it's here. It's very real. The US currently is the market leader in fission, though China is rapidly nipping at our heels. We have 3 active reactors in the US today. And, the challenge, however, is that we have only built 2 in the last 15 years, 20 years. They were in Atlanta. They're called Vogel. They were massively over budget, massively behind schedule. And, there are, no active reactors currently in development from a sort of, all the way through NRC process perspective right now. That is changing. There is, a lot of policy tailwinds, pushing nuclear today.
Push a little deeper on that, because I think that's a real critical issue, right? Like, because when you look at total nuclear production, obviously it doesn't look that bad. But when you look at origination date and new innovation coming online, like we're at 0.
Yeah,
right?
That's right.
China's at 48 or whatever it is, right? And so what are and meanwhile, we're seeing a lot of really innovative companies in both the fission and fusion side in the US that have the potential to provide megawatt scale power for data centers, et cetera. So what do you think are the real keys and triggers or inflection points that are going to allow these companies to actually start spinning up? I mean, I know a couple of them have pilots in place, right? But what's holding that back?
Yeah. And I one data point we should highlight is that 90% of new power generation in the US, roughly, it may have been 85, somewhere around there in 2024, was solar and wind, right? And so renewables are happening. China has deployed massively more renewables in the last 6 months than they've touched nuclear, right? Than they've touched nuclear.
Yeah.
So, just to be clear, there's a lot of dialogue about nuclear in Washington today. And I think nuclear is an important. We needed its clean baseload power. It works at nighttime. It doesn't require batteries to kind of operate 24/7. And yet, solar is a huge success story in the U.S. that I don't want us to gloss over.
Yeah, but nuclear is also dealing with a lot of supply chain issues, right? With Rio and Hilo on the fuel side.
Depends on the fuel, right?
With nuclear, you've got a couple classes, right? So, there's a lot of discussion about SMRs. Mm-hmm. There's, micro reactors. And then there's, the big, like Homer Simpson style, giant gigawatt scale reactors like the Westinghouse AP1000, which is what are the last 2 that we did actually deploy, which are in Atlanta.
So let's just pause and for anyone that's listening, that Westinghouse is AP1000 is essentially like a design from the 60s, if I'm not mistaken, and is the legacy 1 gigawatt reactor that we've been building. We have active AP1000s in development. That architecture takes 15 years to build and billions of dollars, and we're not building them.
I think we will start building them again. Okay. I do predict there will be more large scale, gigawatt scale reactors moving back into the development pipeline. One of the challenges in that space is there has historically not been technology forward project and product management around those deployments. And, I do believe that will change. One of our portfolio companies is a company called The Nuclear Company. They are building, or their goal is to build large fleet scale nuclear reactors. They've just entered into a major partnership with Palantir to build something called Nuclear OS, which is an entire software system designed for efficient project development and project management of large scale reactor construction. These are technologies that are known today. They're operating on the planet. They are producing gigawatt scale power now. And, there is basically zero tech risk to deploying these. And one of the things we have failed at doing in this country is building beyond first or second of a kind reactor. And that's where you get the cost curves to come down. So if we can, and I think we will, begin to build large scale reactors in fleets and can learn from each other and apply those learnings and take a technology-based approach to project development, I think we can get costs and schedules, reined in on the large scale reactors that we already know how to do.
Can you talk a little bit about the regulatory side and how some of these newer projects, including Allo, are essentially fast tracking themselves through?
Yeah. Well, so that's the next topic, right? Which is like SMRs or even micro reactors, right? And so to be clear, today there have been 0 megawatts of any of these deployed anywhere, right? So for as much as we talk about them, there are a few that are public companies today, but none of these are actually producing power in the United States. We're investors in a company called Allo, which recently closed a Series B. Allo is building pods of 10 megawatt reactors. They'll string together 10 of these pods into a 50 megawatt power plant. So again, compare that to an AP1000, which is 1,000 megawatts or a gigawatt. So these are much smaller reactors. The thesis behind a lot of these SMRs is this vertically integrated, industrial manufacturing story where rather than having to go on site with giant, construction crews and, tons and tons and kilotons of concrete and cement, you're actually modularly assembling the actual reactors in a factory, putting them on, designed to fit on a flatbed truck, designed to pass through interstate overpasses, right? Designed to actually move across the United States and then deploy them on site. And so you get your reactor design essentially approved once. And from there, you're building them to spec and taking them and deploying them on site. That's the thesis. Yeah. We believe that these reactors can get through regulatory processes and can get to deployment and to power generation potentially more quickly than large scale reactors because there is a policy friendly environment today in DC for these. And also there is a huge amount of demand pull from hyperscalers, particularly to power data centers, in some cases wholly off grid, but also in some cases, tied to power generation on the grid as well with a power purchase agreement.
I mean, it's
also access to fuel, right? Because the enrichment process for an SMR isn't as involved than it is for traditional nuclear deployments. So the supply chain is a little easier, right? And also I know the military is interested now on the microreactor side too. So now that you're going to see funding coming from there, they need downrange energy production, right?
They are,
so
yeah.
Hopefully that'll clear up a lot of the policy issues that
I hope so. I mean, I still think with nuclear, you probably are still dealing with security guards and guns and, everything you got to deal with when it comes to nuclear. But the thesis is this is another class of technology that we just haven't had in the US. And I think there is a pathway for it for sure.
It makes a ton of sense. And it is such a fundamental change in approach. And it's really necessary. As we were talking about this, I realized like what you're describing, Cody, is the difference between building, something that's expensive and complex, let's say like a private jet on an assembly line, like still expensive and complex, versus building a net new giant airport.
That's right.
Yeah. Right. The scale of the AP1000 project is like building an airport.
Yep.
What Allo's doing is building an assembly line of private jets.
Yep.
And when we figure that out, and there's also different nuclear projects that are like, there's a little bit of like a fuel war going on inside the industry, right? People have different ideas about fuel sources. That will sort itself out over time based on price performance and access. I mean, David mentioned multiple times the supply chain access to fuel, which is super important. But I think we're at a really interesting moment in history as splitting atoms is coming back. And then we're cooking through our time here. So I want to also ask you about
fusion.
Yeah. And what is your personal take? What's MCJ's take? You have bets in both arenas.
We do. Yes. I mean, interestingly, we have bets in both fusion and fission. And in both of them, we have bets on large scale and, small scale. Right. And so in in fusion, we are investors in a company called Pacific Fusion, which is building large scale, utility grade fusion power. Pacific Fusion recently raised, don't drop your jaw when you hear this, but a $900 million Series A led by General Catalyst. And their technology is based on the successful, Q greater than 1 results that have come out of the National Ignition Facility and Lawrence Livermore Lab. They are a pulsed laser technology that we believe has, the potential to truly be a, city scale power provider. You've seen Commonwealth Fusion recently raised another big round of financing as well. And, that's another leader in the space. There's Helion, there's, 4 or 5 like large scale, utility grade fusion projects that are out there today.
All right, look, the fusion's always been around the corner, but 20 years away, right? This is the cliche.
Exactly.
What signals are you seeing now, and what compels you to invest in fusion now versus 5 years ago, and like go predict the future for us? What's going to happen in the next 18 months?
Sure. I mean, we invested in Pacific Fusion after the, Q greater than 1 results came out of the lab, right? So it was the first time. What that means, it's the first time that a fusion power source had ever generated more power than it consumed. And so that is a major scientific milestone. There's still a ton of tech risk here, for sure. But we believe there's enough sort of focus, enough market demand. Google is entering into large scale power purchase agreements on fusion today as well, that these technologies are about to truly be ready for scale. And then I think, I mentioned on the smaller side, we're also investors in a company called Avalanche, which is making small, fusion reactors that can be, roughly a diesel generator replacement.
But you know what the real question there, Cody, is can they build it in a cave?
Iron Man and plant it in their chest. That would be amazing.
So Cody, so the signal on the fusion side was Pacific getting to Q greater than 1, even if it was for
not Pacific specifically, but Pacific's tech is based on that result,
right? And obviously, like for those that are listening and not familiar with this, we're talking about Q greater than 1, like a moment, a microsecond or a half a second. We're not talking about sustained energy production.
No,
there's a lot of work that needs to be done in this industry to get to the point where you have a operating reactor that's sustainable. This was just proving that ratio could be flipped for even a second. And so getting close to that versus it being theoretical was a major signal that got you guys to lean in.
For sure. On the fusion side. Yep.
All right. Put your GP hat on for a minute. How did you guys wrap your head around, and what kind of conversations had to happen both internally and with your LPs to get to a place where out of your current fund, which is sub $100 million, you could justify an investment in a $900 million round?
Sure. Well, that's a portfolio construction question. MCJ will have around 50 investments out of this fund. Most of these investments are sub $1 million. So we're not leading these rounds. We're not driving the rounds to happen. We lean in with capital. And, the goal is to be in the best companies. The goal is not to try to find a diamond in the rough and massage it to the future. The goal is to find the companies that are on trajectory and on path and invest in them and accelerate their progress. And we accelerate their progress in a few ways. One, we have our own podcast, Inevitable, as I mentioned. That's been a great pathway for helping our companies tell their story, get their word out. Two, because we have this large audience and media presence, we have a great set of listeners who get excited about the companies that are showing up on our podcast or in our newsletter and come to us and say, hey, how do I plug into this? How do I get involved? And so we lean in hard with talent. We've now helped more than 90 hires get made into our portfolio, multiple C-levels, multiple VPs, all the way down to individual contributor, engineers, product managers, salespeople. And then 3, commercialization. We have multiple corporate LPs in this fund and have a great corporate network beyond that. And we've done a lot to drive active pilots and co-investments on the commercial side into our portfolio companies. And so, that's our strategy in terms of how we lean in and support our portfolio companies. What that means from a construction perspective is we're okay having a small ownership percentage in a company that we know we can accelerate and, buy low, sell high. Like you're going to get to the point where these companies are growing rapidly.
Yeah. It's about performance and growth from the entry point, right?
That's right.
I think that's, super smart. And obviously, like David and I are sitting here nodding our heads because a lot of what your approach is very similar to what we're doing at Massive, as you know. And we have the same philosophy. If you back exceptional companies that are going to redefine their industry, like the performance is going to be there.
That's right.
I think a lot of, the previous generation of venture got stuck on this, like traditional, like got to co-lead, got to own a certain amount and missed a lot of great opportunities as a result.
We've spent a lot of time talking about deep tech, hard tech, but roughly 50% of our portfolio is software. And, we had a company yesterday announce a $20 million Series A led by Venrock, a company called Euclid. They are becoming the leading software platform for solar power diligence and procurement. So they're helping large scale solar projects actually get through the diligence cycle through AI and document management. Doesn't sound as sexy as, utility scale fusion, but in a world where 80 to 90% of new power that's come online in the US in the last year was renewables, it's a hugely growing market. And there's a lot of great software businesses like Euclid in our portfolio too.
And I think, Ari and I talk about this a lot, and it's great to see it reflected in your approach, right? From a portfolio construction perspective, like someone that marks themselves in an early stage fund, actually being able to jump into a big Series A or a Series B in a company they didn't seed, right? Like that's not something you see very often. And obviously, at Massive, we take a very similar approach. We're multi-stage investors, and we don't care if we seeded it or not. Like we just want to be part of the greatest companies that are building. But you're getting some runtime into how those later stage companies are growing and building. Are you looking at that data and reflecting that back on some of your approach to earlier stage investments? Maybe to rephrase it, like, is it changing the way you're looking at earlier stage investments now that you're doing some later stage investments, or are you still just looking at them separately?
So let me answer that question in two ways. Normally we come in anywhere from pre-seed through Series A. Series A is usually our latest entry point. However, we've made a few exceptions to that.
I know you have. That's why I'm asking.
Notably, Crusoe, which I would say is probably one of the biggest names in our portfolio, we originally came in at the Series B. We're certainly glad we did. Crusoe is the anchor project developer building Project Stargate, OpenAI's major data center in Abilene, Texas. They recently raised $15 billion in project finance to go build that, gigawatt plus scale data center facility. We're thrilled we decided to come in late to that one. We can talk about our decision to do that, if we want to. We recently came into Allo at the Series B, which is also later than we normally come in. And we had some good signal around why that was a good investment for us. And we'd known that company since seed. So that was one where we didn't just get a pitch deck and be like, let's do this one. It sounds cool. Like we'd actually been building a relationship with that founder for a long time.
Yep.
I would say for early stage, pre-seed and seed, we are incredible. I mean, this is a cliche, right? But we are incredibly founder driven. Like what we're looking for at pre-seed and seed, for the most part, are seasoned, experienced founders who have built businesses before. They may be moving into energy, but they know how to be a founder, and we can help them build their network around energy, climate, industrial resilience, all of that. And so when we lean in really early stage, it's oftentimes a founder that we have deep, deep conviction in the human. We think the market is interesting. It's still hypothetical sometimes, and the traction may not even be there at all. And we're okay with that at early stage. So I would say, you were asking about how do we make investments. Our goal is to get into the best companies, particularly when we're coming in at, seed or Series A, or again, occasionally making an exception to come in even later than that. And definitely when we double down at Series B, C, D, E, which we do in our portfolio. Mm-hmm. But when we come in early at pre-seed or seed, it's really about exceptional founder, and the market, the traction, all of that we believe is going to come.
So you're looking for founders with some runtime.
Yes, for sure.
Yeah,
that is a huge thing for us.
Hanan and Exawatt's a perfect example.
That's right. That's right.
Yeah.
Pattern recognition.
Yeah. And then,
I mean, Hannah at Arctic, same thing.
Arctic is a great
She's
example.
a co-founder of EcoFlow, which is, a very large battery business.
That's exactly right.
I've always found historically when, like the conversations you have with founders that have been there before and done it, like, are so completely different than you have with the founders that are doing it for the first time, especially if they're coming out of enterprise, right? And they want to just do a startup and they don't really they haven't worked at a startup before. And those conversations are so much more valuable from an investment perspective. And the ability to work with those founders is great too. So, I'm ranting a little, right?
The
but
energy,
there's a real value to that pattern recognition.
The energy and industrial space, the climate space, these are complex spaces. They have incredibly complex structured deals. They have, difficult, challenging partners, oftentimes regulatory environments in some cases. And, learning that on the job is hard enough. Learning that and just how to be a founder and,
how to actually build a business,
how to manage a team, how to, deal with your investors, how to deal with your cap table. All of that is ideally things that we're not having to help the founders navigate.
Yeah. And I would just one more quick note on that. There's just, I've found, and I've seen in my history, and I'm curious if you've seen the same, like the conversations you're able to have as an investor with those founders tend to be much more vulnerable and open.
Yeah,
right?
for sure.
Than first-time founders that are actually scared to have real conversations with their investors. And that's so powerful as an investor to really be able to help because you're getting the real information.
That's right.
There's something about having the bookend of the first like lap as a founder. Some founders can sort of become the second-time founder on the job in the first company. And those are the ones that start a company and figure out how to like scale it all the way up. But often I find that you really need the bookend of like where regardless whether the project was successful or not, the time to wrap it up, reflect, learn from it before you start your next one.
Mm-hmm.
And I keep wondering like what is so different about a second-time founder than a first-time founder? It's that the experience or the company had an endpoint.
Yep. I'm really interested to see how the current phenomenon of what I would call the American dynamism thesis. I had Catherine Boyle and Aaron Price Wright on my show recently to talk about that, and that whole thesis is, find people from the school of Elon who have lived these like heavy vertically integrated operating environments at SpaceX or Tesla and are now spinning out to do their first thing and can apply lessons learned. And they're one of the only people on the planet who have, built vertically integrated American industrial companies, or not built, worked inside. I'm really interested to see how that thesis ultimately plays out in terms of their ability to be successful then building their own. We have made, certainly some investments with that founder profile as well, but it's a different founder profile. Like being a director of product at Tesla or SpaceX is different than having been a CEO before. And I think both are really interesting founder profiles, but they have unique challenges to them for sure.
In cases where the founder profile is not, a Hannah or a Hanan that clearly have had that runtime and that prior success, what market or traction signals do you look like to offset or help the underwriting if you can't rely on that?
Yeah, that's a great question, Ari. I think we do look for more market and traction signals. Even if it's, again, someone coming out of a SpaceX or whatnot, we're less likely to go in, first check super early there. And what we'll tend to do is to really try to help them with, talent introductions, commercial introductions, and use that as an opportunity to get some signal on their ability to not just be great at building their product, but be great at building their company. And then that may mean we'll come in around later, but we'll have done some de-risking on our end.
Yep.
Awesome. So let's hit you with a couple of rapid fire questions as we kind of get to the end here. So, your mind, what do you think is the most overhyped thing in climate and energy investing right now?
Oh boy. Well, overhyped is this is going to sound funny to say, but
overvalued.
I'll go with overhyped. I can't tell you how many companies I meet with today that, a year ago were pursuing market A and today are pursuing market data center. Mm-hmm. And I think that's fine. There is incredible market pull there. There is a little bit of a skeptic in me who is reminded of 5 or 6 years ago when company couldn't figure out their market. And then next thing you know, they were doing NFTs or crypto with their technology somehow, or blockchain. And so I do worry a little bit about that. Like, how recent is your data center pivot story? And where, how do you have actual market signal that market wants your technology, as opposed to just, yeah, it's going to be a big market, so of course I'm going to go build there.
Related to that overhype, do you think that there's risk in the hyperscalers and these giant data center projects, that if the sort of first wave of LLMs get disrupted with something that's way more efficient, that the scale of these projects is being overcooked?
I don't know if it's that. I don't know if it's the whole, a new LLM technology is going to come along. I mean, obviously we saw that happen, last year out of China, but I do worry that there is more of a macroeconomic challenge, which is that these large tech companies have sustained such incredible valuations over the last decade plus because they have super high margins. And the more they invest in infrastructure, the more those margins may compress. And, if all of a sudden they get beat up in the public markets because of that, and then these projects slow down or projects start to fail and private credit takes a bath, there's a chance that there could be a significant financial event that happens in that world. I do worry a little bit about that. I'm not a macro guy. Like, I'm an early stage founder guy. So I try to not let things like that worry me too much, but that is something I think about sometimes.
Yeah, when you try and shift from early stage to macro, do you have to take your hoodie off and put your jacket on, or is that?
I know the world I know, and I can do my best to try to read the tea leaves, but that's just not how I invest. I am very founder driven.
Speaking of founders, what is one founder behavior that tells you this company is going to win?
I've seen enough founders now that I think there is a positive correlation between how good the founder is at actually following up and delivering what they said they were going to deliver in a conversation in a timely manner, to how good they are at just actually operating their company. And so it's little things that to me actually mean a lot. The other thing I would say, I look at, you guys, we started the conversation by saying, I started in product, right? I look for founders who have done a good job at understanding how to learn about their market early, and have, can name some experiments they did, or have a why to something they pursued because they were trying to actually get learnings out of it. Founders who have that and say, we did these things, here's what we learned, and here's how it informed where we're going next. That's the kind of founder mentality I'm personally drawn to. Again, I think that's just because of my own product background and proclivities.
That tracks. And then last question for you. You've spent a lot of time out here in Colorado, obviously, in this ecosystem. You're on the West Coast, you're a global citizen. When you think about energy, deep tech, and what's sort of going on in the world in different markets, here in the Rocky Mountain West and in Colorado, what's one advantage you see for our market, or one of the things that might be unappreciated by folks that are, East Coast or Silicon Valley centric?
Well, I think for sure Colorado and the Rocky Mountains have a rich history of knowing how to extract things from the ground that have value, whether it's minerals, whether it's oil and gas, so there is a lot of knowledge on how to leverage resource in the Colorado community. That, and I would say you've got the Air Force there, which, and sort of all of the power around that, whether it's National Renewable Energy Lab, NREL, and just know-how there locally. Those are unique local resources to your markets.
Awesome. Thank you, Cody. We really appreciate you joining us on Massive Signals, and it is always so nice to see you, my friend. And let's try and do a whole bunch more deals together.
I'm looking forward to seeing you guys in person in like 2 weeks at Techstars FounderCon, right?
It's around the corner. Fun. Looking forward.
I'm excited.
Thanks, Cody.
Thanks for having me, guys.
Love the conversation. Good to see you.
It. Thanks for tuning in to Massive Signals. If you enjoyed today's conversation, be sure to follow us on Spotify, Apple, or YouTube, and share the episode with someone who cares about the future of deep tech. and subscribe to our Substack at massive.vc to stay in the loop on all of our current investments, thinking, as well as upcoming events like our quarterly Deep Tech Table Dinners and the second annual Deep Tech Summit May of 2026. Find it all at massive.vc. Until next time, keep listening for the signals that are shaping our future world.